Hi, this is Peter from GameOfTrades.net, and today we're going to discuss the long-term picture on the stock market. And I wanted to start off the video by showing you this chart of the Dow Jones Industrial Average. So the stock market showing you that stocks always go up. So today we're going to talk about what's driving these moves over the long term to the upside and whether that's going to continue to be the case over the next decade. So today we're really going to focus on that long-term picture, talking about multiple years ahead, not the short-term picture. In the short term, you guys know that our view stays the same as long as we're above this trendline resistance that we've recently broken. We're extremely bullish on the stock market. We're likely to see some crazy moves in the next few weeks. Very similar to what we saw in 2008 right here. That break of resistance led to a blow-off top move towards the end of the bull market cycle. So that's the phase that we're currently in right now. If we fail back under this resistance line, then that would have big bearish consequence on the chart. But we're not going to focus on the short-term picture today. We're going to take a look at the longer-term view, and we see some big fundamental problems with the stock market in the long term, which is why we think gold is going to vastly outperform the stock market over the next few years. And that's exactly what we're going to talk about in this video. In fact, we're going to talk about that in the next two videos because there is just so much information to talk about regarding that. So let's go back to that chart of the Dow Jones over the past 100 years to understand why the Dow Jones always goes up in price. We have to add something to this chart called the money supply. So this is the amount of US dollars currently in the system. And you can see this is not a stable number. You can see this goes up over time. Unfortunately, we don't have the data on this chart going back to much earlier on, but I can draw it on for you. It's pretty much the same thing. It's a steady increase of the money supply until 1934, when the United States went off the gold standard. This is when they were able to create more dollars than the amount of gold in the system. And that pretty much changed the entire game. I'm about to show you all that in this video. So I think you get the concept. This is what creates inflation. It's what pushes stocks higher. It's what pushes prices in general higher. It's why the price of a house in 1960 was around $10,000 and now it's $300,000. That's a big jump in price, and that's the money supply creating these changes. So something you may have noticed is that the money supply is going up very steadily over time, but the stock market is making these moves up and down around the money supply. And that's what you call booming cycles and bust cycles. So what that basically tells you is that sometimes the money supply goes into the stock market, like throughout this period and like throughout this period, but sometimes it doesn't go into the stock market, like between 1960 and 1982, where the stock market went sideways for around 15 to 20 years. But lucky for us, the money supply does go somewhere else, just not in the stock market. And that's where we can hop onto a historical chart of gold. By the way, if you want to have access to these charts, you can click the link in the description to access the charting platform. This is the best chart of gold on TradingView. It goes back the farthest. And so again, you can see this is the gold spot, and it goes up constantly over time. In 1916, gold was $19 an ounce, and now it's $1,900 an ounce. So that's 100 times what it was worth 100 years ago. So again, if you're in that camp that says stocks always go up, then you should also be saying gold always goes up. You should also be saying housing always goes up, because the truth is that the dollar always goes down. So we can draw the same thing on this chart, the money supply steadily going up over time. And we can draw the same conclusion that we had on the previous chart, and that is that gold makes these bull and bear markets around the money supply. So you can see between 1970 and 1980, you had this big secular bull market in gold, and here you had a big secular bear market. And I'll give you guys a hint. Our thesis is that gold started a secular bull market in 2000 and is about to complete it in the next 3-4 years. So we're going to see this type of price action on gold in the next 3-4 years, really parabolic moves in the price of gold. But I'm getting ahead of myself. There's a lot more to cover before that. So I think you get the point that our investment thesis at GameOfTrades.net, this is what we've explained to our members, that we're trying to follow the money supply. Whether the money supply is going to be going in gold or whether it's going to be going in stocks and not in gold, we're here to figure that out and position accordingly. And I can tell you, if you've managed to do that over the past 100 years, you would have made a lot of money. And it's crazy to see how few people understand that now, despite all those patterns that we've seen throughout history. So now one of the big charts that we use is the Dow to gold ratio. So what we basically do is take the stocks that are measured in dollars and divide that by gold that's measured in dollars. And so if you know your maths, you'll know that cancels out the dollars and you're left with just a ratio of stocks to gold. And so it takes out that crazy money supply that always goes up and always pushes these asset classes higher, and you're left with the true relative value of stocks to gold. So let's take a look at that. And that's very easy to do. You just go on the Dow Jones Industrial Average and you divide that by the gold chart that we just had. And that's how you get the Dow to gold ratio on TradingView. And you're left with this chart that goes sideways. This is a range. Remember the other charts that always go up? Well, this is a ratio that goes sideways. And so you realize very quickly that it's not true that stocks always go up, because you would have been able to buy the same amount of stocks in 1928 with an ounce of gold than you're able to buy now with that same ounce of gold. So over 100 years, stocks did not go anywhere compared to gold. So this chart is extremely powerful. We've already made the calculations on gameoftrades.net with our members to the kind of gains you would have been able to make if you sold your stocks and bought gold at the top of this range, and you bought gold and you bought into the stock market at the bottom of this range, right? Same thing here. You buy gold, you buy stocks, you buy gold, and you have another opportunity here to buy gold. So this ratio is the technical aspect of why we believe gold is going to outperform stocks, because this ratio is elevated. But now, does that fit into our fundamental view of the stock market? And that's very important. You can't just trust one chart and base your capital and base your entire investment thesis on just this chart. It needs to fit with where you see the stock market going in the next few years and where you see gold going in the next few years. So that's exactly what we're going to discuss in the rest of this video and the next one. Is the stock market really as expensive as this chart makes it out to be? And to answer that question, we're going to take a look at a few charts from sentimenttrader.com. You can go check them out. They have a lot of great content, and their charts really take a look at equity valuations properly. So this is the first chart, equities as percentage of GDP. And it makes sense, right? You want the stock market to be proportional to the economic output, which is the GDP. It wouldn't make much sense to have stocks be disproportionately overvalued compared to the economic output of the nation. And you can see this ratio is telling us that we're extremely elevated in terms of equities per GDP. So they're expensive compared to the economic output. And in fact, we're at all-time highs. Now, we've shown this chart before. You can look that up on Google. It's the Wilshire 5000 to GDP ratio. So we're going to move on to the next point. And now we're looking at equities as a percentage of total assets. And again, it makes sense. You want the stock market to be somewhat proportional to the rest of the asset classes. It doesn't make much sense to have the stock market be disproportionately valued to, let's say, the housing market. And that's something that we're seeing right now. Either the stock market has never been this strong in the past 100 years, or we are in a very speculative market fueled by the current monetary environment. Now let's take a look at PE ratios. So this is the S&P 500 PE ratio. It wouldn't be a Game of Trades video if we didn't take a look at that. We're not going to spend too much time. It's really elevated. So this is the past 100 years, and we have PE ratios at extreme high levels. Now, the primary argument against looking at PE ratios is that we have tech companies, and tech companies have naturally high PE ratios because they're based on growth. And so investors are willing to pay a higher price for the growth that's expected in the future. But the problem with that is that it's not just the tech stocks. If you look deep into it, you'll see that most of the S&P 500 stocks are overvalued. not just the tech stocks. And that's very important to understand. The ETF in general is overvalued. Now we can take a look at IPOs. This is something we took a look at on the site the other day, and it shows you that in 2020 we had a spike in the number of IPOs, very similar to the spike we had during the dot-com bubble in 2000. So that tells you, again, this is a speculative market. We had a lot of stories during 2020, let's say Uber, Airbnb, DoorDash. Those were companies that were highly indebted, that didn't have profits, and where investors poured into those stocks because of growth expectations. And I'm not here trying to tell you that that doesn't make sense. These valuations and speculations are a direct consequence of the monetary environment that we have. So let's take a look at interest rates over the past 54 years. This is the 10-year treasury rate over the past 54 years. And so you can see we've been in this downtrend. This is interest rates, remember, a downtrend for 40 years. So the lower this is, the easier companies can borrow money at a very cheap rate. So let's say Uber can go out to the bank and borrow massive amounts of money. And so they leverage themselves. And so that boosts growth expectations. And so the investors pour into those stocks because they have high growth expectations. And so that's why we're in a speculative market, and it completely makes sense. And just that fact alone doesn't mean that the stock market is going to underperform, right? If you think that interest rates are going to stay low for the next 10 years, right? Natural interest rates are going to stay low for the next 10 years, then maybe this overvalued bubble is just going to keep on growing bigger and bigger and bigger, and speculation is just going to get out of hand. That may take years before it flips. So if you believe that environment is sustainable, maybe investing in the S&P 500 at these levels isn't that bad of an option. But in the next video, we're going to explain exactly why we think that this business cycle that we've seen over the past 40 years with declining interest rates, low inflation, why that's about to potentially flip, and why we're about to see the end of that speculative market and stop seeing the money supply flow into the stock market. So tune in for that video. And if you're interested in knowing more about our investment strategies at gameoftrades.net, our vision for the stock market, precious metals, cryptocurrencies, emerging markets, commodities, and when we're positioning into them and when we plan on exiting, make sure to go and check out gameoftrades.net by clicking the link in the description below. Now, in the meantime, I wish you good luck on your trading and see you next time.